All right, Mallory, we are here talking about your article explaining the Washington State 7% capital gain tax, what it is, how we can understand it, and then strategies folks can use to address it in their planning. So if you don't mind, can we just start with a brief overview of what the tax is and how we should understand it?
Absolutely. So in 2021, Washington State passed the capital gains tax effective in 2022. And this is a tax that's charged on the sale of certain assets once that gain exceeds $250,000. It's been controversial because Washington State's constitution prohibits an income tax, but the Supreme Court of the state passed it as an excise tax.
Got it. Yeah, that was all in the headlines for quite some time. And looking at the tax itself, it's interesting because what it appears kind of to be is an effort to capture some revenue from the sale of large tech company stocks. Over the last decade, to nobody's surprise, Seattle has blown up in terms of the number of tech companies that are stationed here. And so, as those employees who receive lots of stock as part of their compensation go to sell that, Washington State was hoping to grab a piece of the revenue because lots of the assets that are excluded include real estate and certain types of businesses and things like that. So I guess that would make sense if that was the objective there. And taxes are, as we both know, one of the most common frustrations we hear about from clients between income tax and capital gain tax and estate taxes. It seems like they never end. So you address some really helpful strategies to tackle the tax in your article. But maybe you can start with kind of a framework that we use as advisors to help clients understand what strategies might be appropriate for them.
Absolutely. So we talk about wealth as a way to enjoy life, provide for loved ones, and impact causes we care about. And when we're looking to sell assets, we're always looking at which assets are subject to the tax. And so before that, we want to understand, what is the purpose of the money behind the goals, and then what are the assets and how do we look at them through that tax lens, especially now in the state, so that we're not getting unintended taxes on our income tax returns.
Yeah, that makes sense. And in the article, you cover strategies kind of for each of those three goals. We hear regularly from our clients that that framework of wealth as a tool to enjoy your life, provide for loved ones, and impact causes you care about really helps to kind of segment what they can do with it. So maybe what you cover quite a few strategies in the article, too many to cover in a brief video like this. But maybe we can touch on one example of a strategy that folks could consider depending on which of those three goals they're focused on. Why don't we start with if they're selling assets to enjoy their life, provide for their living expenses, and so on?
Right. So for that strategy, we're often looking at what the asset base is, how much they need, and where we're going to sell to stay under that $250,000 threshold. That's a major filter for our review process. And this can also incorporate something like tax loss harvesting, where we're looking somewhere on the balance sheet to say, there's a loss over here, let's harvest it because we're taking gains over here. So we want to have that full comprehensive picture when understanding the tax implications for sending those monthly checks out so that our clients can live their best lives. We're also talking to our clients that have that large company stock. And as those shares are vesting, understanding the opportunity to hold based on stock price or making the recommendation to sell to also be managing taxes throughout the year.
Yeah, that's great. That's an important aspect of the law to understand is that it doesn't kick in until you sell up to and over that $250,000 of gain mark. Um, the second goal that you talked about is selling assets to provide for people that you care about. In our planning, this might be selling stock to create proceeds to help an adult child with a down payment on a house, pay for an education, start a business, things like that. One of the things that we often consider there is that $250,000 gain is per household. So a husband and a wife together are subject to that single limit. But if I have adult children that are a separate household, I might consider gifting them the stock I was going to sell letting them sell it so they can use their $250,000 of gain. That specific aspect we hear about frequently with home purchases and other things like that when a generation one is trying to give money to generation two or three, but they have a lot of gain baked into those assets. So I found that that strategy you put in that the selling assets to provide for loved ones aspect extremely helpful, and I know a lot of other people have as well. Um, let's move on maybe to the last section and talk about what somebody could consider if they're selling assets to give to charity.
Great. I'm glad you brought that up. So, a lot of our clients do give assets to charity. And so, a really effective way to avoid the capital gain tax is to actually give stock directly to the charity. So, you're not going through a transaction where you're selling and then stroking a check, but rather gifting the shares and realizing the full deduction of that gift without incurring any capital gain or income tax. Another option to consider is the donor advised fund, where appreciated stocks are put into an account. The deduction is recognized today, but those dollars can then grow for the benefit of the charities of your choice, either today or at some point in the future. So there are absolutely strategies to consider to both reduce your tax bill and also impact the causes you care about.
Yeah, those couple of aspects are extremely helpful because, as you mentioned in the article, in a donor advised fund, not only can you move the stock there, get the deduction for maybe a higher dollar amount, but then you get to sell it without any capital gain tax. So lots of ways to shift dollars that would be lost to taxes to a cause you care about instead. Super helpful, Mallory. Thank you so much for covering these strategies. If you're watching this and you got here by going to the video directly, you can click the link in the description and that will take you to the article itself. If you're watching this through the article, there's a lot of other helpful links that Mallory, that you generously put into the article, things like about tax loss harvesting and other gifting strategies that link to other strategies that our team members have written about. So if you are looking for an approach like this in your plan, we put a Let's Talk link at the bottom of the article. You're welcome to click that and reach out to have an initial discussion. And until then, we hope this has been helpful to you.